Somewhere we have all grown up. From the heartaches of an ex-girlfriend to the strategic brilliance of an ex-dividend, we've learned that not all exits are that painful. Some bring profits also. From the energy boost of a Red Bull to the market's roller coaster ride between the bear and the bull, we discovered that adrenaline doesn't just come in a can. It thrives in the stock market. From the laughter of Munna and Circuit to the serious takes of upper and lower circuit, we understood that timing is everything, whether in comedy or in trading. From worrying about the future tenses in grammar to mastering futures and options in finance, our perspective shifted from sentences to securities. From the simplicity of black and white TV to the vibrant hues of red and green in the market tickers, we embrace the colors of profit and loss, learning that every shade tells a different story. From BSc and MSc to BSc and NSc, our academic pursuits have laid the foundation, but the stock exchanges have become our real classrooms. From the fun of mutual camaraderie to the wisdom of mutual funds, we have learned that pooling resources can lead to bigger, better returns. From the sensationalization of India TV and the architects of the world to the analytical insights of CNBCs and Z Business of the world, we switched from consuming news to understanding the nuances behind every market move. From playing a Junjuna in our school to idealizing Junjunwala, our heroes have changed from toy sellers to stock market legends, teaching us to dream big. From spending in the market to investing in the markets, the stock markets, we grew from impulsive buyers to strategic investors, understanding the real game is in growing wealth, not in just spending it. We all grew up, and along the way we transformed our understanding of the world. From innocence to investment, from games to gains, this is our journey of growth, learning and endless possibilities. Growing up, we all started somewhere simple, from playgrounds and school books to the bustling, vibrant world of finance. This journey is a testament to your growth, to your evolution, to my growth. And let's endeavor to learn finance in a bit more practical manner, because we all have to grow up and scale up our game in the domain of finance. So in this video, I'm going to share with you how to read ratios practically. I mean, we all know ratios, but how do you fundamentally analyze stocks having a practical perspective into the field of finance? That's what we are going to learn in this content-based video. And over here, I'm going to discuss with you about ratios in the practical way of comprehension of it. So I'm going to discuss with you about specific ratio. For a financial health checkup, we have profitability ratios, we have profit margins, we have liquidity ratios, we have turnover ratios. But for this, the context of this video, I'm going to specifically discuss with you about the interest coverage ratio, the practical application and understanding of it. Right? So the interest coverage ratio, in case you are aware of, it helps understanding the liquidity position and capital structuring. And over here, if the definitions that we have understood, interest coverage ratio, it's the ratio is a ratio of debt and profitability ratio used to determine how easily a company can pay interest on its outstanding debt. Right? That my operating profit is how much time sufficient that I can pay off my interest cost. Okay. So the interest coverage ratio is calculated by dividing the company's earnings before interest and tax, which is your operating profit, by its interest expense during the given period. So the actual formula that you must have studied in your school days or in your college or in your professional courses, it's EBIT upon interest. EBIT upon interest, that is your interest coverage ratio. Right? That how much my operating profit is sufficient to pay off my interest cost or not. Right, so higher the ratio, better it is that I'm able to, I'm earning sufficient that I can pay off my interest cost. But let's see the practical application of this. Let's take an example. I'm talking of this company called Tata Steel. It's a listed company And what I have over here is I've taken the data from screener.in and about the financials of Tata Steel for the last 10 years from 2015 onwards till 2024. You have the sales data here, you have the interest cost here, you have the debt cost here. Now, in case you have your debt amount, let's talk of 2024. Your debt amount is almost 87,000 crores. So this data is in crores, right? And you have if you have taken in debt, you're also supposed to pay interest on it. So how do you actually get it? Your interest cost is a part of your profit and loss account. So your interest amount is coming over here around 7,500. Similarly, your debt in the last year was 84,000 crores and you have your interest amount of 6,299, which is okay. Giving you an interest cost percentage as a percentage of debt around 6%, 5%, 6%, 5%, 6%, 7%, 8%. I mean, think over it. Tata Steel is able to raise money at 6% or 5% from the banks. Now that's not possible. I mean, banks will not lend to Tata Steel at 5 to 6% or 7%. Because in a way this digresses the actual business of the banks. The banks take money from people like you and I. They give us some assured income in terms of fixed deposits at 5%, 6%, 7%, and they create a definite alpha for themselves and then lend to the corporates, at a higher percentage, keeping their own margins intact. So Tata Steel is able to raise money at 6%, 5%, 6%. This seems a little weird, and believe me, I have not cooked any of the data here. It's actual authentic data. Okay, and if this seems like a fallacy or an outlier here, let me give you another example. Let me give you an example of this company called Tata Steel Authority of India Limited. It's again a publicly listed company. And in this, if you see the interest amount is 2,400 on a total debt of 36,000 crores. An interest amount of 2,000 on a total debt of 30,000 crores, giving an interest cost as a percentage of overall debt as 4%, 6%, 6%, 7%, 6%, 9%, 6%, 6.8%. Now that is again not possible. This is not possible. I mean, a company called a Steel Authority of India Limited, it's a listed company, able to raise money at 4%, 5%, 6%. Whereas the fixed deposit rates of the banks are upwards of 6-7%. And I'm talking of 2015 and 16. I mean, even if I talk of the COVID years, in COVID years, the bank rates really went down, right? But the bank, the company is able to raise money at 7.5%, 9%. Something is not right here, but I have not cooked any of the financials. Let me give you another example of this company called NHPC. Again, a government-owned, publicly listed company. Right? It is the interest cost as a percentage of your overall debt is around 6%, 5%, 5%, 3%, 2.5%, 1%, 1.5%. That's not possible. Even if our Prime Minister says Modi hai to mumkin hai, that is not possible because company cannot raise money at 1 or 2%. That dilutes the entire essence of the banking system per se. So what is actually happening here? Pause this video, think through, is there some fallacy here? Is there some lacuna here? Now let me explain this to you. For example, if you find out the interest coverage ratio based on what all we have understood, right? So the formula that is EBIT upon interest. That is the formula for interest coverage ratio that even I know that we have studied. Okay. Now over here, my EBIT is 4,800 in the last year. It's 4,800 here. And your interest amount is to the tune of 402, right? So giving you an interest coverage ratio, ICR, of almost 12 times, 12x, right? Whereas you understand logically, any bank is not going to give you money at this small rate of interest of 1, 2, 3, 4, 5%. That's not possible. So if I were to analyze this company, what I'll do is I'll maybe assume a rate of interest. Assume a rate of interest that maybe the bank lends at say 10% or 11% or 12%. Let me assume a rate of interest which is basis my convenience or basis my financials. Because you take it that this is not possible. So if I assume a rate of interest of say 10% hypothetically, just for the sake of understanding, so a 10% rate of interest on this amount will be around this much, around 325 rupees. So over here, if my operating profit is 4868 divided by an assumed 10% rate of interest on 32561, it comes out to be around 3256, which is just about 1.5x and not 12x. This is what we have studied, around 12x, which is wrong. Whereas the actual interest coverage ratio would be somewhere around 1.5x in this situation or in this scenario for this year. Now what has actually happened over here? Let's try to understand a concept called capitalization of your interest cost. That means what? That actually means what? Let's just understand this with your eyes and ears open. Let's try to comprehend it. Let's take a situation. Say I'm from an economically humble background and my daughter gets into IIM Ahmedabad, right? One of the most premier MBA college of India. Say for the sake of understanding, the cost of IIM, the 2 years of MBA program for IIM Ahmedabad is 25 lakhs, right? So this is the cost of MBA. Both me and my daughter are very happy that she has got into one of the best MBA college in India, and high probability that she'll have a good life after that once she gets placed. Now the catch is, because I'm from an economically humble background, I do not have money to fund her fees. So I approach an ICICI bank, right? ICICI bank says no problems. Will not let your daughter's dream die down for lack of money. We'll fund her fees. We'll fund her education. Both me and my daughter are very happy that ICICI bank is going to fund our fees. Now, it's a 2 year of MBA program for her. So 1 year and 2 year of MBA program. Okay, 25 lakhs is the total fees. So for the sake of understanding, let you comprehend that her principal repayment will start when? Once she is done with her MBA or once she starts working. There's a catch here. Your principal repayment starts once she is done with her MBA, irrespective of whether she gets a job or not. Because what if she chooses to go for an entrepreneurship or for that matter? So in that case, your MBA cost is 25 lakhs. The repayment starts after once she is done with her MBA, maybe after some moratorium period, keeping that aside. However, the interest cost starts when? For the sake of understanding, let's take interest cost, let's say around 10%. My interest cost is say around 10%. The interest cost will start on the very first day, the day she has taken the loan. Right, so I'm shooting this in the month of July of 2024, this video. Right, suppose her MBA starts from August of 2024. Okay, so the interest will be paid when? The interest will be paid from the very first day that she has taken the loan. The very first day, the amount that comes to her account, that is when the interest payment starts. The principal prepayment will start once she's done with her MBA. The interest payment will start once she is sort of, got the money in her bank account. And for 2 years, she's not going to earn anything, right? And so the first year, the interest cost amount is 2,250,000. Next year, it is also 2.5 lakhs, 2,50,000. Okay. Now, I do not have capacity to pay this interest amount also. So what do? ICICI Bank says no problems. We won't let your daughter's dream die down for lack of money. What you do is that instead of taking a loan of 25 lakhs, you rather take a loan of 25 lakhs plus 2.5 lakhs plus 2.5 lakhs. Okay. So for my daughter, because this amount of 2.5 lakhs into 0.5 lakhs, a total of 25 lakhs makes it around 30 lakhs. Okay. So use this 2.5 lakhs to pay the interest during the time she's not going to earn anything. And this 25 lakh rupees is the cost of the MBA, right? Which is supposed to be paid to IIM Ahmedabad. Okay. Now, for my daughter, the cost of MBA has increased from 25 lakhs to 30 lakhs, in which 5 lakh rupees has been capitalized and added as part of her cost of her MBA. I repeat what I said. In this 30 lakhs of the cost for my daughter is 30 lakhs for the entire MBA, out of which 25 lakh went to IIM Ahmedabad. The remaining 2.5 lakhs and 2.5 lakhs is the cost which has been capitalized and added as part of her cost of her MBA. Now this means what? That additional 5 lakh rupees has been capitalized and added in her MBA cost. So for my daughter, the total cost of MBA is 30 lakh rupees. Same analogy when it comes to the businesses. In my profit and loss account, all those income and expenditure will come once the business has actually started operations, right? So any kharcha, any expenditure which has been incurred prior to it, that will not be expensed in my profit and loss account. That will rather be capitalized and added as part of cost of the project. You'll understand this better with this with this flow chart here. If you have a cost here, any cost which is before start of operations, you're going to either capitalize it or you're not going to capitalize it, right? So any kharcha which is incurred after the operations have started, right? So that goes to the income statement. Before start of operations, that goes to your fixed assets added as part of cost of your fixed asset. I go back here. I go back to Steel Authority of India Limited here. Now over here, your total debt is 36,000. That means, assuming a rate of interest of say 10% here, if you have a 10% rate of interest here, you're supposed to charge interest of say 3,600 rupees over here itself. However, what is coming in your profit and loss account is 2,400. So remaining 1,200 rupees has been capitalized and added as part of your fixed assets cost, which will eventually go in your depreciation. I go back to the example of Tata Steel here. In case of Tata Steel, if your debt is say 87,000, right? For the sake of simplicity, let's assume your rate of interest is say 10%. You have actually paid 10%. You have actually paid 10%. You're not absolved of not paying the interest, right? However, these Tata Steel and Steel Authority of India Limited and NHPCs, these are capex heavy companies which require significant amount of capex in the initial phase. So any kharcha which is incurred before start of operations, that will not be expensed in my profit and loss account. That will rather be capitalized and added as part of cost of your fixed assets. Just like in case of my daughter, that example which I gave you. For her, the total cost is 30 lakhs, even though IIM Ahmedabad only got 25 lakhs. The remaining 5 lakhs of interest amount has been added as part of cost of your MBA. Okay. So any kharcha which is incurred before start of operations, that will be capitalized. Any kharcha after the start of operations, that will be added as part of your cost of your MBA. Okay. And now this flow chart will make more sense. Now you see this here. The cost which is capitalized, it is going to create a economic benefit, example machinery, right? And cost which is not capitalized, it will be for an immediate benefit such as fuel used in the business or delivery, as the case may be. So any kharcha which is capitalized, that will be added in the asset side, and any kharcha which is done after the operations have started, that will be expensed in my profit and loss account. Eventually both of them will go to your income statement, this in the form of depreciation. The second one in terms of the expense as an interest on as-is basis. But from an understanding of our perspective, the same thing is happening over here in case of an NHPC or a Steel Authority of India over here. Actual interest cost is in this case 3600 only. Steel Authority of India has actually paid 3600 rupees. However, the balance 2400 out of this, or balance 1100 something, 1126 rupees something, has been added somewhere as part of your fixed asset cost. Okay, so same thing in case of Tata Steel also. If my rate of interest is say 10%, the actually company would have actually paid 8700 as interest cost, out of which 7500 has gone into the profit and loss account, because it might be for the expense which has been incurred for the business which is already in operations. But for any other expense which for a factory setup which has not started operations yet, that balance amount of say 1300 rupees has been capitalized and added as part of cost of your fixed asset. So to conclude, understand, when it comes to the interest coverage ratio, this is the textbook definition of interest coverage ratio, right, that we have studied in our professional courses. But when it comes to actually analyzing companies, if we go with the textbook definition, the way I just showed you for NHPC, with an interest coverage ratio of almost 12x as per the textbook, whereas the actual interest coverage ratio over here could be somewhere around 1.5x. There could be lot of dissections of the analysis that we do. So for the purpose of our analysis, let's assume an interest rate and accordingly calculate the actual interest expense, and not with the textbook definition of this. Okay, I'll give you an interesting anecdote here. With respect to this company called Byju's, in case you have understood this concept, I'm talking of 2022, when of course Byju's was doing exceptionally good. At that time, Karthi Chidambaram, son of Mr. P. Chidambaram, who was a member of parliament at that time, I'm talking of 2022 here, in case you can see this properly in the screen. He had raised certain red flags in the parliament at that time. So, and this is on record, it's available. So let's, basis the understanding that you have had so far, let's actually try to comprehend what actually the red flags that he had raised at that time. He said that analyzing how Byju's earned its money where it has spent, it is puzzling. Nearly 81% of its operating revenue constitutes sale of edutech products. This includes sale of tablets, SD cards, and whatever it is. Right? This, as per them, is a blatant misrepresentation of the fact, which is fine. Let's not even discuss the first part. Let's discuss the second part for the purpose of our understanding. He says on the expenses front, and let's read this together, 60% of the costs related to employees have been recognized as a capital expense rather than an operational expense. You understand? If these costs were counted as a direct expense instead of a capital expense, Byju's loss would have gone over 5,000 crores. That year, Byju's reported a total loss of 2,000 crores. But in that, the employee cost, which was supposed to come in your profit and loss account, was not shown in your profit and loss account. Rather, it was capitalized and added as part of your fixed assets, so that your profits could be, your losses could be shown lesser. It was 5,000 crores and it was shown as 2,000 crores of losses. So that is something which he raised at a time, and not much heed was paid at a time. But we all know what situation Byju's is in right now. Right. So what I've just taught you is capitalization of the interest cost. And once we are understanding the interest coverage ratio, let's learn it from a practical perspective. In case you found this video useful, share with your friends and your colleagues so that they can also get some practical understanding of this, right? And visit www.thewallstreetschool.com or call us at 93550-57509 for more details about the financial modeling and valuation programs that we conduct, because what we teach in that program is a practical perspective of theoretically what we all have studied. So thanks for watching, and I look forward to more interactions with you.